Bankers do not like transparency, right? They do not like regulation. It makes their lives difficult. And I'm not talking about the previous speaker at all, obviously. I'm just talking in broad generalities. But the more lack of transparency, or in English, do we know the word opacity? Opacity? Opacity means lack of transparency. That window is very clear, you can see out. But if I put a frost on it, if I put a bunch of lines across it so you cannot see out, it's still a window, but it's opaque. It's not transparent anymore. And for bankers, the more opaque their bank and their pricing and their products are to consumers and to the public, the more opaque they are, the wider the margin they can charge on those products. The wider is the difference between their cost of funds, primarily deposits, and their use of funds, primarily loans. If you make it all transparent, then those margins shrink. So this is something that we should, as reporters and journalists, we should keep in mind, particularly when you're talking to not just commercial bankers, but central bankers oftentimes do not like transparency for a public policy reason, not for their own reward, but in order to carry out the mission of a central bank. They often like to work in a very opaque, non-transparent fashion. So that's kind of an understanding that we should have. Yesterday we talked briefly, and you're going to talk more tomorrow about derivatives. And in that regard, you'll talk about over-the-counter derivatives. Does anybody know what I mean when I say over-the-counter, OTC? Okay. Well, OTC is the ultimate in non-transparency. And until 2008 and the financial crisis, that is the only way that derivatives, $60 trillion of them by whatever count you want to use, nominal value or face value, gigantic market, operated only OTC. Over-the-counter means that you and I negotiate and execute our own transaction, and no one knows about it. There is no record kept of it other than us. It's not listed on an exchange anywhere. It doesn't go through a clearinghouse, right? It's OTC. It's person to person or institution to institution. Well, that's okay if it's just a one-off. But when we're talking about literally trillions and trillions of dollars that have the potential to take down our entire financial system and the real economy with it, now we all have skin in that game, right? We all have something at stake. So bankers, particularly big bankers, and by big I don't mean 6'4", I mean $2 trillion asset bankers, where coincidentally 97% of the derivatives market is concentrated in these big banks. These big banks hate transparency. because the more transparent it is, the narrower their margins become, the smaller their fees are, the less they get to put in their wallet. Okay? So around the world, efforts are being made to make that market more transparent, to require that derivatives trade on exchanges and go through clearinghouses so that not only market actors, but regulators and investors will know what the buildup is of assets and risk in that corner of the world. We started to get into yesterday how vital trust and confidence is in our financial system. Without trust and confidence in our financial system, where are we? Nowhere. We are in economic chaos. We are in social anarchy. And that's not an overstatement. So what are the underpinnings of trust and confidence? Well, for retail depositors, we have deposit insurance. None of us, I don't think, lose sleep overnight over the fact that our bank might fail tomorrow because we know that our deposits are insured. Now, if we had deposits over the 100,000 euro or whatever the cap is, we might worry about that amount of deposit, but for the most part we don't. Most of us don't have $100,000 or euros or more on deposit in our checking account. Am I right? Does anybody want to self-identify as having that much money in their? In which case, I'd like you to take me to lunch. Backing up that, protecting the institution, not necessarily our deposits, is the central bank as a source of additional funding or liquidity for the banks. Then we also know, as the previous speaker indicated, that the central bank is exercising supervision over those banks. So we take some trust and we have some confidence that those public servants in the central bank are doing their job and overseeing the bank. We know that part of the regulatory process is that banks have to keep a certain amount of capital pursuant to the Ukraine National Bank of Ukraine's rules, but also according to Basel that we talked about yesterday, the national standard setter. So that layer of capital protects us, gives us some more confidence. We know that banks are very concerned about their reputation because if they damage their own reputation, they run the risk of a run on the bank, like we talked about yesterday. So there's a certain amount of self-governance that goes on because of the concern that banks have for their own reputation. And then we know, or we think, that banks will not be reckless in their lending. They will not make stupid loans, although they do from time to time. And we know that they know that if those stupid loans become public, that too can damage the reputation and hence the trust and confidence that the public has in the institution. So for all of these things, we're relatively comfortable, we're relatively confident that our banks are safe. The most important ingredient, however, in underpinning our confidence is transparency, right? Now, there are two kinds of transparency. There's the information that the institutions make known to us, the public, in the form of filings, in the form of shareholder statements, whatever other disclosures are required, the public transparency. But then there's the quasi-transparency that we know exists between the institution and its regulator. We know that the regulator requires certain reports. We know that the regulator sends in bank examiners. So we know that there's a certain amount of transparency going on there, right? We are also assisted in some regard by, Chuck was talking yesterday about stock analysts who follow the equity shares that are publicly traded of financial institutions and study them and try to predict what their earnings are going to be or whether they're going to have losses. So this all accumulates into the public perception of these institutions. When these institutions go to market to issue debt obligations, bonds, then the credit rating agencies, has anyone here ever worked for or wrote about credit rating agencies? Credit rating agencies? Yes, you have? What are the major credit rating agencies? Fitch? S&P, and what's the other one? Moody's, yeah. There are others, but those are the big three. They occupy the field. So credit rating agencies issue reports, and they say that when Citigroup is issuing a bond, because it's Citigroup, we'll rate it AA, say. And you take some trust and confidence from that, or at least the investor community does. Large banks are dependent highly on something called overnight funding, right? They borrow on a 24-hour basis. We'll get into that a little bit when we talk about the tools by which central banks regulate the money supply, as Vladimir was talking about. So the fact that a bank is able to continue its operations through overnight funding indicates to us as bystanders that other bankers must see this bank as credible. Otherwise, they wouldn't be lending to it. Or they'd be lending to it at such a wide spread, such a large risk premium that too would send a signal. So this adds to our confidence. And then finally, and this is probably the one combined with overnight funding, these two combined were the matches, or not the matches, but the kindling that caused the fire of the financial crisis, the so-called knock-on effect, that unknown consequence that will result from the failure of a too-big-to-fail bank. This fear and trembling that if one of these institutions fail, it will cause a domino effect or a contagion effect or a knock-on effect on other institutions, and therefore we will never allow it to happen. This was the mentality in 2008. I wanted to put up here a income statement in general terms and a balance sheet for a bank. Yeah, good. So if this is insultingly basic for anyone, let me know and we'll cease. But the main thing I want to focus on is the balance sheet. A balance sheet of a bank consists of a number of things. Assets on the left and liabilities and shareholders' equity on the right. And what are the assets? Well, number one is cash, right? We need that because people come and they want their deposit money back. We need to feed the ATM machine. Loans of all types, right? Commercial loans, auto loans, home loans, small business loans. Sometimes a loan will take the form of a lease, but it's really a loan. And then we have this, what's called a contra account, which is deducted from loans, and it's called, in the U.S., we call it the allocation for loan and lease losses, ALLL. I'm just going to call it the reserve here. Right? And that gets deducted from the loans. Now, why do you suppose we deduct from the loans? Anybody? Why do you think we would? Why would we deduct? Why would we have a reserve against loans? And when I made a loan, was it you that? Who did I make the $100 loan to yesterday? It was you. Where is she? She took my money and she didn't come back today. That's what exactly. We answered the question because we know as a bank, we know historically, even though every loan when we make it on day one is a good loan, all right, or otherwise would be crazy to make it or corrupt, right? So in theory, every loan we make it is a good loan, but we know from experience that a certain percent of loans that we make are not going to be good, right? And we can go back in history, years, decades, and we can actually calculate what percent of those loans are going to be bad. And we can look out into the future, into the economy as it is and is predicted to be, and say, well, gee, we're going into a very difficult period, so in light of that, probably more of our loans will go bad than in good times. So we set up a reserve, and we deduct it from the loan. So it's a little bit like capital, but not exactly. Right? And then we have investments. All right? Loans are illiquid, right? If I make witness the $100 million loan, she's gone out the door, not to be seen again by me or anyone else. That's $100 gone, right? If I made, even if she was here, and I asked her, that $100 I gave you yesterday, I want it back today, and she'll say, wait, I don't have it, I already spent it, So it's illiquid. And yet we are a bank. We stand ready to redeem your deposits every day. So we need to maintain a level of liquidity. Right? So we can't maintain that liquidity with loans. If we keep it all in cash, what does cash earn? Zero. Right? Cash is cash. So what we do is we put it into investments. Government bonds, mortgage securities, commercial paper, other kinds of things. And then we might own the building that our offices are in, so we'll have hopefully a small amount of real estate. Or what do you call it? Property. Property in London, real estate. Okay. On the liability side, how does a bank fund itself? What's the main source of funding for a bank? Money. Deposits, right. Deposits. That's far and away the preponderant source of funding for a bank. Deposits. But banks also issue bonds. They raise money in other ways. So that's why I put up there other, right? And then in the U.S., we have something called a federal home loan bank system, which I happen to be a director of one of our federal home loan banks, and it stands there as a source of funding for banks. But banks primarily...
Can I ask you?
Sure.
Because our previous speaker told us about this refunds from central bank in Ukraine. How it's works.
Refunds?
Yeah, from central bank.
Refunds.
Yeah, refinance.
Oh, refinance.
Refinance. Yeah.
Um,
So
I-
when some state, so the central bank of our state gives money for some commercial banks.
Yeah.
Yeah, just it's as a way to get money for banks. So I
Okay.
such a way here. So you don't have such a system in the United States.
I will get into that. There are two ways that the central bank in the U.S., and I assume it captures what Vladimir was talking about. There are two ways in the U.S. that our central bank, the Federal Reserve, provides money. One is through something called the discount window. Right? Each of the 12 Federal Reserve banks maintains a discount window. And if a bank is illiquid, not insolvent, but illiquid, if it's experiencing some turmoil, it can go to the central bank, the discount window, and borrow, usually at a penalty rate, a high rate. The problem with that is that even though the two parties might keep it non-transparent, the market figures out whether the bank has been using the discount window. Trust and confidence. If the market knows that Bank of America, for example, is a regular visitor to the discount window, what does the market say about Bank of America? It's in trouble, right? Or at least it's risky. So if Bank of America is risky, then I, as a provider or a buyer of its other bonds, right, I'm going to do what? I'm going to require a higher risk premium. So the discount window is there, but there's a phrase that we use to capture central banks, whether it's the Ukrainian central bank or the U.S. central bank, and it's what? Lender of what? Last resort? Have you ever heard that one? Lender of last resort. You might write that phrase down. Lender of last resort. So if you're a bank and you go out to your central bank as lender of last resort, that means you're experiencing some problems. The other way that the central banks lend to their banks is through the exercise of their monetary control function. All right? And we'll get in, and if you just hold that thought, we'll get into that way that they provide funding. So that's the liability side. Then we have equity. Now remember the formula that we had. Assets equals liabilities plus owner's equity. Here we come to the equity portion of it. We have shareholders' equity, which is what? It's money that the founders put in when they licensed it in the first instance. That might be 50 years ago. It might be 2 years ago. Founding money from shareholders, plus the proceeds of any secondary offerings they might have made of equity, common shares, in the interim. This is the ownership interest in the bank. The other portion of equity is what we make every year. It's the retained earnings. It's the net income on the income statement income statement being like a movie. You know, it tells you what the operation is making in a short period of time versus a snapshot at the end of each quarter or each year, the balance sheet. At the end of a period, you take the net income from the movie and you transfer it into the balance sheet. All right? But something happens between here and there. And what is that? What happens to that net income that can minimize it? Well, net income is the profit. The whole institution makes so much profit, right? But before it becomes part of equity, some things happen to it. It gets whittled away. What? Well, no, taxation would be above the line. It gets taxed, and then net income is the bottom line. When people talk about the bottom line of something, they're talking about net income. But suppose I pay dividends. It's good to know who the players are. Not only is it good to know who they are, but as we were probing just a moment ago, it's good to know what their background is, what their biases are, what their pressures are, what constituencies they have to answer to. And if I heard correctly, I think there was some question raised as to whether Mr. Sorkin, even though he has grown up within the bank and is qualified, sounds like he might not be the strongest or the most articulate or the most independent person in the world. I'm just guessing, right? Nobody's saying your guess is way off. So, like I said, Chatham House rules, right? I'm just visiting. So we have the Federal Reserve, Ben Bernanke. Okay, we have the European Central Bank, Mario Draghi. Everybody know that name? Heard the name? Yep. And we have the Bank of England, Mark Carney. He's been in for just a few months. Came from the Bank of England, very well-respected banker on the world stage. While he was at the Bank of Canada, he was made the head of the Financial Stability Board, a very influential body based in Basel. And I was going to, before we had this presentation this morning, I was going to have a pop quiz asking you who this guy was. But we've already established that, so we don't have to go there. All right, this is too small to read, but the first line is very important. It says the Constitution of the country sets up your central bank. Not the laws, not the legislature, not an executive order, but your Constitution. In the U.S., I think I mentioned this yesterday, we went without a central bank from 1776 or 89, when the Constitution was finalized, until 1913 without any central bank. And then by act of Congress, not through the Constitution, the central bank was created. Why does that matter? Constitution versus a law. Huh?
Constitution is only one, and it's the main law of the country. But Congress is different. People changing sometimes. There can be some lobbyists, some groups of.
Well, what is? Yeah, you're right. You're right. 100% right. But what's easier to change here, the Constitution or a law? A law. Okay. Same in the U.S. So the Fed we think of as independent. Arthur Burns, despite his knuckling under to Richard Nixon, was purportedly independent. However, he knew that at any moment Congress could pass a law and eliminate the Federal Reserve, just like it passed a law and created the Federal Reserve, right? So you are in actually a better place than we are in terms of the independence structurally of your central bank, because it's in the Constitution. We could have a separate seminar about the history of banking in the U.S. and the opposition by agrarian farming communities to banks of any kind. So it was just not thinkable when the U.S. Constitution was being developed for us to have a central bank. And in fact, we wouldn't have any banks at all. Has anybody ever heard of Alexander Hamilton? Alexander Hamilton? He's probably the most important public figure in the U.S. ever, other than Michael Jackson, who was never president. He authored large sections of the Constitution and was the first Secretary of the Treasury, trusted associate and friend of the first president, George Washington, and he was the one way back then who had the foresight to say, look, we have all of these colonies after fighting the Civil War, after fighting the Revolutionary War, why don't we, as a federal government, all these states, former colonies, are wounded because they have so much debt built up as a result of the Revolutionary War. And he said, let's guarantee all that debt at the federal level, right? And that will bring the colonies together as a nation. Huge leap of faith, because at that point we had no income tax, we had no means of taxation. But between that and creating a standing army for the federal government, it allowed us to even think about having banks, let alone central banks. So this goes through some of the responsibilities that your central bank has. Monetary policy we talked about, issuing the national currency, rules of conduct for banking transactions, support the system, all these, it goes on and on. This is from Wikipedia, by the way, so you know it's a reliable source. Let's talk about how the Fed does its job, because it's similar to the way a lot of banks do their jobs. First of all, banks create money. Did you know that? Did you know banks create money? They do. You do? Not your central bank, but there are two. Right now, I'm talking about private banks. The $100 loan I made yesterday, even though it's gone bad, what I did was I made a loan. What was her name? Did she have a name? I'm not a very good banker because I lend money and I don't even get the name of the customer. That's why I'm an academic, I guess. Well, let's say her name was Joan. All right, so we loaned to Joan out of thin air. We now have an asset on the books for $100, right? That wasn't there yesterday. And what does Joan do with that $100? Well, but before she spends it, she doesn't spend it that day. She probably spends it a week later, right? Or whoever she pays it to has to do something with it. So two scenarios. One is I make her a loan for $100 and she puts it into her deposit account. That's what you would do if you had a loan. And then she spends it. Might be next week, might be next month. But whatever, the instant I make the loan, my balance sheet has increased by $100 on each side. Now when she does spend it, she's going to pay her dentist, okay? And the dentist is going to take that $100 and put it in his or her bank as a deposit. So that one loan ricochets through the system many, many times. It's called the multiplier effect. And it increases what? It increases the supply of money. The supply of money and credit in the system. Right? So that's how banks create money. Now, how does we'll skip the Fed for a minute and come back to it. But is that an end or 5 minutes? Okay. Reserve requirements. A certain percentage of these deposits, small percentage, is kept in non-interest-bearing funds at the Federal Reserve Bank of the district, wherever the bank, commercial bank, is located. So like 3%, say. Not a lot. But enough so that when you apply that small reserve to the multiplier effect, right, it has the effect of retarding the growth of the money supply. In other words, the higher the reserve requirement, the lower the velocity and the lower the growth of reserves. So reserve requirements, that's one way the Federal Reserve and other central banks, including the Bank of China, influence the supply of money and credit in the system and loans. Open market operations, right? Within the Fed, there is something called the Federal Open Market Committee. The Fed consists not just of Ben Bernanke, but it consists of Ben Bernanke and 6 other governors. Ben Bernanke, by the way, is going to be he's going to be leaving in January, we think, and he's going to be replaced. And how many of you, please tell me, some of you watched the video that I asked you to, the warning, right? Well, there was the heroine of that was Brooksley Born, all right? But her antagonists, the people that were Alan Greenspan, Robert Rubin, and Larry Summers. Well, our good friend Larry Summers is leading the parade of people to be appointed as Ben Bernanke's secretary, to the chagrin, to the sorrow of many of us, both for what he did in the warning, but also for many other things that he's done throughout his career. So anyway, so you have the 7 governors, the chairman and 6 governors, and then you have something called the Federal Open Market Committee, which consists of the presidents of each of the 12 Federal Reserve banks around the country, Boston, New York, San Francisco, on a rotating basis, so that you end up with a total of 12 voting on this Open Market Committee. So the Open Market Committee is the one that decides what the interest rates are going to be, and the reserve requirements, and the money supply, generally. So one of the ways that it influences the money supply is by buying and selling government securities. So if I want to increase the money supply, do I buy or sell government securities? And other kinds of securities. Huh? I would buy, yeah. So I would buy. Security comes in, cash goes out. And there's no muss, no fuss. I just press a keystroke at the Federal Reserve Bank of New York, say the biggest one, and presto, on the balance sheet of a bank appears a massive deposit, right? I have the securities, the bank has the deposits, and also they have to keep reserves against it, and the money supply has gone up. Because banks have to keep these reserves, at the end of every day, they have to settle out. Some are in a surplus position, some are in a deficit position. In other words, some have more reserves than they need, and some have less. So the ones that have more than they need, they don't want to have that money with the Fed earning nothing or close to nothing overnight. So what do? They sell that money to other institutions, right? In the form of Fed funds. Have you ever heard that term? Federal funds? It's probably the key interest rate that the Fed tries to control. The Fed establishes a target for the Fed funds rate. I think the target is now between 0 and 0.25%, right? The Fed is aiming for an inflation rate of 2%. Comment on quantitative easing. Is anybody familiar with this term? Huh? Quantitative easing? It's highly controversial because in terms of the government intervention in the economy, and you might want to keep this in mind, there are two forks: fiscal policy and monetary policy, which we're talking about here. Fiscal policy relates to the taxing and spending practices of the government, which are determined largely by the executive and by the legislature, right? And then monetary policy, as we're talking here. Well, in the U.S., we have gridlock. We have an embarrassing situation where nothing can get done in the form of either taxing or spending, increasing taxing or increasing spending. Give me 1 second. So as a result of this, and as a result of the dual mission of the Fed to increase employment, the Fed has embarked on this quantitative easing. Now, what in terms of our numbers yesterday, our what were they called? What do you call them? What kind of numbers? Reference numbers? Chuck, remember we went? Huh? Context numbers, yeah. So what was, somebody had the GDP for the Ukraine is 120 billion annual? What is it? 165 billion euros? Dollars. Okay. Well, for context, the Fed has announced, FOMC has announced that every month, it is going to buy $85 billion every month of government securities and mortgage-backed securities until what happens? Until unemployment gets to from 7.6%, which it is today, to 6.5%. A couple of weeks ago, after one of these FOMC meetings, Chairman Bernanke gave his press release, and he uttered some words which signaled to the world that this quantitative easing thing, this program of $85 billion a month, was going to taper off at the end of this year and come to an end at the end during 2014. Over $85 billion, no more, right? The markets, particularly the bond market, reacted wildly. Holy cow, you're going to do that? They immediately sent out the governors and the presidents of the reserve banks to walk it back and say, no, we didn't really mean that. Point being that probably the most powerful tool that the Fed and other central banks have for controlling the monetary system is through communications, through the things that they say to you and to others about what they intend to do next month, next year. So, for example, in the last year, the Fed has said that it intends to keep interest rates low for the next 2 years. Didn't do anything. They just said what they were going to do. And the markets react. Right? I don't know. The dollar as the reserve currency of the world, the central banker there has the ability to, and the power to make such statements like that and have them have an effect worldwide. I'm not sure you could say the same for other central banks where the currency is not the reserve currency. Okay, we've already talked about the structure of the Fed, and when we come back this afternoon, we're going to talk about the financial crisis, right? What caused it? Who were the players? And I want to get your reactions to that. And then we're going to talk about some of the global reform, financial reform initiatives that have been put in place and are planned.